All right. Hey, good afternoon, everybody. This is Tim Hilligoss from Clayton and McKervey. We're going to take about one more minute. We're a little before 3 o'clock, and we still got quite a few people in the queue logging into the program. So hang tight, and probably in a minute or two, Margaret and Casey and myself will go ahead and get started. All right, Margaret, I'm going to go ahead and ask you to unshare your screen just for a second so everybody can get a little better view of us. Welcome. Welcome again to one of our live video series. And Casey and Margaret and myself want to welcome you. My name is Tim Hilligoss. I'm one of the shareholders at Clayton McKervey, along with one of our tax shareholders, Margaret Amsden, and one of our senior managers, Casey Haggerty. We're hopefully going to bring some insight to change. I was thinking about this earlier, that we are actually in an industry and maybe in a time where there's so much change between tax law and the politics of change that, and none of it has to do with technology when you think about it. I'm going to look at Casey and Margaret for a head nod. A lot of the things we deal with every single year, and none of it has to do with technology. Now, mind you, we do have technological changes, but a lot of it comes from our governments, legal system. It's an interesting career and an interesting time to be a CPA, especially working remotely with all this change going on. So again, welcome. This is our second series, our second seminar in this tax update series, where we'll be covering some of the changes and some of the strategies you might be interested in looking at. For those of you who were online last Thursday, we had Sarah Russell and Miroslav Georgiev going through kind of the impact to businesses, and Margaret and Casey today are going to cover individuals and estates. A little bit of housekeeping real quick. Just want to make sure you guys understand the format. We can't see you. You can see us. There is a tab on the right side of your screen that allows you to ask us questions. Margaret's going to be presenting on the topic and hopefully covering anything you might think of. But in light that she doesn't cover everything you've thought of, the idea is you're able to ask us questions live. Casey and I will be watching those questions. And one of the neat things about this system as Casey and I go through this is you may have a similar question to someone else. And first of all, let's go back to the basics of having hosted presentations for many years. More than likely, somebody has the same question you do. So please don't be shy. Margaret, Casey, myself, we love what we do. We love this type of stuff, and we want to make sure we cover what you need to hear from us and hopefully answer all your questions. So don't be shy about asking questions. But there's a really nice little feature within this program that allows you to upvote. So if you see a question that's important to you, if you go ahead and click on that triangle, that'll let Casey and I prioritize those questions. We'll do one of two things. Casey and I may be able to answer your question typing on the sides. Casey and I know about Margaret's presentation, so we may just hold off and wait and click the Margaret is answering live button while it occurs. And if we see enough activity in there, we may actually interrupt Margaret and try to maybe have some dialogue and maybe ask a question live that's important to all of you. So keep that in mind. We want to make sure you use that upvote. Definitely ask questions. And we should have some time at the end of this program. For those of you who are used to my spiel and my speech, I apologize for the opening remarks here, but we try to get you done at 4 o'clock. One of the things that Sarah Russell and I were dealing with respect to the payroll protection program loan presentations and live videos was very often we were getting 50, 60 questions an event, and that would push us a little past our hour timeline. And so right off the gate, we've asked for permission occasionally to go long if we like the questions we're seeing and we think it's good information and it's not redundant or too hypothetical to really have a decent conversation. We'll probably keep the line open or keep the live video going a little bit after 4. Otherwise, just want to let you know, if you need to leave at 4, that's fine. All the questions and the live video will be available afterwards. Denise Asker, our marketing director, will make sure that all of you get whatever you need to make sure you're able to follow up on this with either the questions as well as the video. Just a couple updates, a few things I want to make sure you're aware of. We may have misspoke or mispresented the payroll protection update that we're planning for December 15th. For those of you who were a part of that series, I think we had almost 10 in total of updates from both the loan application period all the way through the loan forgiveness application period. And I think Denise and I may have mentioned, Denise through the question section and myself in the presentation, that you were all welcome to attend a December 15th update. And that was probably overstating what the update is. That's actually specific to the Risk Management Association of Southeast Michigan. And that's lenders, people in the finance business, where we're going to talk about from their perspective what are some of the things they need to be aware of. So it may not be the detail that you're looking for if you're a closely held business looking for what are some of the issues I might face on the loan forgiveness application. So this is going to be more of a presentation directed towards lenders and bankers and kind of get them the perspective that we've seen, the 3 of us working with our clients throughout the last few months on the application forgiveness. Some interesting things here. As I said before, Margaret and Casey are going to talk about change and the change that's occurring. One thing I'll mention that came about 2 hours ago, it looks like right now Congress is getting closer and closer to possibly having another stimulus bill. I know that the House has been asked to come back by Tuesday. That's always a good sign. When they're calling people in, there's a couple differences. Some of the differences are on the funding and the aid for states and local governments, and the other is trying to give liability protection to businesses, essentially. So there's still a little bit of gap there, but the fact that Steny Hoyer, who is the majority leader in the House, has asked people to come back to Washington, D.C. on Tuesday, to me, that's a good sign. They know they've got to get this thing moving next week in order for it to be effective and be able to put it into place before they go away for the holidays. So I'll view that as a good sign. Margaret, I'm going to go ahead and ask you to pop up your presentation. And so I've covered kind of the background and the housekeeping, and I'm going to turn it over to one of my peers and a great asset to our firm and to our clients, Margaret Amsden.
Thank you, Tim. And of course, I'm new to this, so bear with me. Over the last, I've been with the firm for 20-ish years, and back when we were all getting together live for breakfast, used to do a pretty regular tax update early December. So this is a kind of common thing for me. But one of the things I want to just reiterate with regard to what Tim said is please don't hesitate to ask questions. Tends to make for a much more interactive presentation and make sure that you get what you're looking for. With regard to what we're going to cover today, we're going to talk about individual income tax. There's a lot of things that are proposed. We don't really know exactly what they're going to look like or if they're going to happen. We're going to talk about the Biden proposals. We're also going to talk a little bit about the Secure Act, which passed at the end of 2019 and is applicable for 2020, as well as the CARES Act, which has some income tax and planning implications, which passed in early March of 2020. So, and then again, we'll have some time at the end for Q&A if you've got questions, but please don't hesitate to ask them as we move along. So to start out with the Biden proposal. So what we know right now is that, Joe Biden and Kamala Harris have been elected to president and vice president. Still waiting for the final steps to go through there from an electoral college standpoint. The House has retained control with the Democrats, and the big question gets to the Senate. So we've got 2 open seats in Georgia. If both of those go Democratic, then we end up with a 50-50 split in the Senate, and Kamala Harris would pass any deciding votes as the vice president. So what's interesting is, depending on what happens in Georgia, could have a huge impact on what portions of the Biden tax proposal actually are able to be passed. Some of them are fairly aggressive, but just to kind of go through some of those changes and what people are thinking. So Biden's proposal focuses very heavily on people who have income in excess of $400,000. So with regard to the increase in the top ordinary tax rate, currently it's at 37%. The proposal is that it goes up to 39.6%. The current 37% bracket for married couples filing jointly doesn't kick in until you get to close to $600,000. But there's also the potential with the Biden plan that that 39.6 would come in lower at closer to the $400,000 level. So it's not only an increase in the rate, but they're also going to hit that rate sooner. Sticking with the theme of making sure that the folks at the top end of the spectrum are paying their fair share, there's also the proposal to increase the tax rate on long-term capital gains. So long-term capital gains and qualified dividends under the current tax law are taxed at a couple of variable rates, the top rate being 20%. Could be lower, but the top rate's 20%. And what the proposal is that those dividends and long-term capital gains for taxpayers with income in excess of $1 million would be ordinary income, which is a 29.6% increase in the tax rate on capital gains in excess of $1 million. Earned income. So when you think earned income, think wages, non-employee compensation, those kinds of issues are earned income. Currently, when you have earned income, right, you pay Social Security taxes, which is the 12.4% piece of it, on the first $137,000 of income that you have. You then continue to pay Medicare taxes on your income in excess of that. Well, the proposal that Biden has put out is basically going to create a donut where you pay that 12.4% Social Security up to the 137, and then you start paying it again when you go over 400. The Medicare tax would apply to the full scale. So right now you're paying 15.6% roughly for 137 and below. Then you would pay the 2.9% on that gap, and then you go back to that 15% on everything over 100,000, which is a pretty aggressive position. Then there's some things that have more of an indirect impact on your tax rates. So currently, under the current law, you've got the qualified business income deduction, or the 199A deduction. Sometimes we call it the QBI deduction, which gives taxpayers a 20% deduction on their pass-through business income. And what the proposal is right now is that deduction would go away for taxpayers making more than $400,000. So again, while it's not a direct tax increase, it's an effective tax rate increase by losing that deduction. With regard to itemized deductions, there's a lot of things going on there. So we know that under the current law, you've got a limitation on your state taxes. They've also increased substantially the amount that you get for your standard deduction. So there's fewer people who qualify for itemizing. The plan is that the limitation on state taxes may go away, but they're also planning on bringing back a lot of the limitations that used to be there for people that were more high income. So there's going to be some changes. We don't know exactly what they are, but there's going to be a limitation on itemized for people going over $400,000. So it looks like there's some activity in the questions. Is there anything we should talk about before we go on to the next slide, Tim?
Yeah, Margaret, I think that the theme of the questions is at what point do you have this increase in tax? Is it long-term capital gains over $1 million? When you're over $1 million, or if you're $1 million income earner, is it all of your long-term capital gains? And I think similar to the incremental increases in tax rates, and I'm not sure that's defined yet when they kind of put this out there, but maybe you can address what you've seen in the past, for example.
Yeah, so I think probably the biggest challenge is that, these are proposals that were put out during the election cycle, and none of it has been turned into legislative language. And so we don't really know what it's going to look like when it actually comes through. Historically, the way it's worked is we work in a graduated rate system. And so there are lower rates that apply until you get to a certain point, and then everything in excess of that is at the highest rate. I would anticipate, for example, on ordinary income, that it's going to be a graduated rate system up to 400, 39.6 over 400. Similarly with long-term capital gains, he has not said that he was going to get rid of that 10 and 15% rate for the lower income earners. So my expectation is it'll be 10%, 15%, 20%, and then when you go over $1 million, it's those capital gains in excess of $1 million that are being taxed at those higher rates. But again, we really haven't seen any legislative language that would give us enough detail to be able to say that for sure.
Okay, great.
So going on to our next slide, sticking with the theme of trying to make sure that folks that are at the lower end of the brackets continue to get assistance where they need it. There's a lot of discussion in his proposals with regard to expanded credits, including the child care credit, the child tax credit, earned income credits, and the ACA, so the Affordable Care Act, has premium tax credits that people qualify for if they are within 400% of the poverty level, so about $60,000 for a married couple. Those credits are all scheduled to be expanded. We don't have a lot of detail on what those will look like, but there are some opportunities potentially there. So again, we're just on income tax right now, but we wanted to talk a little bit about what should we be thinking about from a planning perspective around these income tax provisions, right? So anytime you're in a position where your tax rates are going up, then you end up in the question of, should I be considering accelerating income and similarly deferring deductions, right? So historically, thinking about capital gains, for example, oftentimes at the end of the year, you're talking to your investment advisors, and your investment advisors are talking about all the different strategies around harvesting losses. And when you consider what happened in the stock market this year, we started out high, we took a huge dip, and then it rebounded pretty healthily towards the end of the year. So you may have losses, you may not. The question is, should you harvest those, take them against current year income, or because we know what this year's rate is, do we defer those losses and wait and harvest them in early January when they would be potentially offsetting taxable rates that are higher? There's been a huge amount of merger and acquisition activity out there. Lots of people who had transactions that at the beginning of the year they weren't sure were going to go forward. By the middle of the year, they were starting to negotiate, and now they're all pushing really hard to try and get those transactions closed before the end of the year to make sure that they lock it in at the current year rates. And while we've got a little bit of time to play with this decision, it's with regard to installment sales, should I use that opportunity? So for those of you who aren't familiar, an installment sale says, if I sell something in year one and I get most of my proceeds in year one, but then I'm going to have proceeds coming through in year 2 or 3, the automatic way the IRS handles that is you pay tax on what you got in year 1, and you pay tax in year 2 and 3 as you collect those. So you pay your tax on an installment. There is, however, an election that you can make that accelerates that future income into the current year. So the election would need to be made on your tax return, and you'd need to be covering that tax by the time you extend your tax return. So it's something that we don't have to decide today, which is a good thing because we don't know what's going to happen with, the control of the Senate. So we don't really know how much of this could potentially be passed, but it's a decision that you'd want to make by April of 2021. So you've got some time to think about it, but electing out of installment treatment may be something that makes sense. There's also an opportunity to consider converting traditional IRAs into Roth IRAs. So for those of you who have an IRA out there, the Roth IRA provides for tax-free growth as opposed to tax-deferred growth. So a traditional IRA, I put money in tax-deferred, and I pay tax when I take it out. A Roth IRA, I pay the tax on the money before I put it in, and when I take it out, assuming that I'm over 59 and a half and I've met all the rules, I take it out tax-free. So all of that growth comes out tax-free. There's also more generous provisions with regard to requirements to take that money out. So, if you've got a very sizable traditional IRA account, rolling that into a Roth IRA may give you better long-term income benefits, and you'd be potentially paying tax on that conversion in a lower income year as opposed to waiting until the potential tax rates go up. So I'm going to go forward to the next slide unless you see any questions we should stop to address at this point, Tim.
I think you're good, Margaret.
Okay. Okay. So the Secure Act. While we're on IRAs, the Secure Act passed in December of 2019. There was a lot going on, and I don't know that it necessarily got all of the attention that it maybe should have gotten, but it made some pretty significant changes to an area that has been pretty much set law since the early 60s. So historically, once you reached 70 and a half and you were required to start taking money out, you were no longer allowed to put money into your IRA. The Secure Act repealed that maximum age limit. So while you do have to have earned income in order to put money into an IRA, it doesn't matter how old you are. So if you retire or if you stop working full-time but you're still doing some consulting, you still have that earned income, even though you may be required to take money out, you can still be putting money in. So that's a big change from an IRA perspective. It also changed the age at which you're required to start taking your required minimum distribution. So again, since the early 60s, the rule was that you had to start drawing on your IRA, and there's a calculation of how much you had to draw based on the value of the account at the end of the prior year and your age. And what it said was you start drawing by the April 15th following the date you turn 70 and a half. Just because, they don't like to do anything easy. They've changed that age now to 72. So if you turn 70 and a half before December 31st of 19, the old rules apply. If you turn 70 and a half after 12/31/19, you're no longer required to take that money until you hit 72, and then similar rules apply. So if you turn 72, you've got until the April 15th of the following year to take that first distribution. Keeping in mind, you can always take money out of your IRA before, you just can't take it later than that. And keeping in mind also that if you take it before, there's some penalties if you take it before you're 59 and a half. That age didn't change. There's also an opportunity to make some charitable contributions from your IRA. So we talked a little bit about our current law where they capped the ability to deduct state taxes, and they increased the standard deduction very substantially. So there's a lot of people who fall into that bracket where with $10,000 of state taxes, if I'm a married couple filing joint, I'd have to make charitable contributions of, $14,000 or $15,000 before I had enough deductions to actually be able to itemize, right? That's assuming you don't have mortgage interest. So if you're in that bracket where you're over the required distribution number and you want to make charitable contributions, you can make those charitable contributions direct from your IRA. So what happens is the money goes from your IRA to the charity and essentially never hits your individual tax return. Under the old rules, you'd take the money out, you'd include it in your income, which increases your adjusted gross income, and then you would take the itemized deduction for it if you qualified for itemizing. This, again, allows you to go straight from your IRA to your charity, and it never hits your individual income tax return. And that's capped at $100,000 a year. So it's a pretty generous ability to be able to utilize those IRA funds to fund your charitable bequests without actually having an income tax impact.
Yeah, I think, Margaret, this goes to one of the questions that Ed asked, and Casey kind of addressed it in his response. When Margaret explains that direct giving isn't included in your adjusted gross income, it means you also get the state benefit. If you're in a state that pays income taxes or charges income taxes, you're not including that income like you would have in the traditional method of taking the cash, getting a 1099-R, and including that in your income where you pay 4.25% in Michigan. And I think you explained it well, how it helps maximize the benefit of utilizing the standard deduction, $24,000 for married filing jointly. So there's a chance you can actually not only save the state income taxes, but increase or reduce your overall taxable income.
Correct. Okay. The Secure Act also impacted stretch IRAs. So stretch IRAs, when you think about an IRA, when I pass away, I'm going to name a beneficiary to my IRA account. Under the old rules, whoever my beneficiary was able to draw that money out over their remaining life. So if I was, say, 80 years old and I named my 20-year-old grandchild as the beneficiary of my IRA, the money after I died, they would be allowed to take that out over their lifetime. So they would stretch that benefit out over a very long period of time. That rule has now changed, and it's limited the ability to stretch. So you can still stretch if your beneficiary is a surviving spouse. If it's your child, so a dependent child under the age of 18. If you have somebody who's chronically ill, they can stretch it because you don't want all that income hitting them at once. Or if your beneficiary is less than 10 years younger than you. For anybody else, that stretch is gone. So if I had a 20-year-old child and I left them $1 million IRA as my beneficiary, they would be required to take that money out equally over that 10-year period. So spend essentially $100,000 a year. So that's a big benefit that people used to use from an estate planning standpoint, allowing people to take an IRA and stretch that benefit, because all the time that it's sitting in the IRA, it's growing tax deferred. So the longer you can keep it in that IRA vehicle to grow tax deferred, the better the tax benefit is in the long run, right? That benefit is essentially gone under the Secure Act. The Secure Act also impacted kiddie taxes. So just to kind of take us back in history a little bit, if we go back to prior to 2018 and the Tax Cuts and Jobs Act, that's what TCJA is. So prior to the Tax Cuts and Jobs Act, When I had a child, I would calculate mom and dad's taxes, and then I would calculate the child's taxes based on the parent's highest marginal rate. Now, there were some exceptions there with regard to earned income, and they might be able to take some standard deductions and whether they could file on their parents or separately, but essentially they were filing at their parents' highest marginal rate. When the Tax Cuts and Jobs Act came in, they changed that rule and said all of your kids are going to basically pay tax using the trust tax rates. So trust tax rates mirror the same graduated rates as individuals, with one exception. With individuals, you don't hit the highest marginal rates until you're, $600,000 for a married couple. I think it's $400,000 for a single. Whereas a trust reaches that highest marginal rate of 37% at $13,000. So those kids didn't need to have nearly as much income to hit that highest marginal rate. Now, selfishly, from the tax preparer standpoint, I kind of liked that scheme because I could compute the kids' tax without mom and dad being done. Whereas under the old rules, if mom and dad weren't done until the summertime because they were waiting on information from their pass-through entities, all those kids had to get extended along with them because we wouldn't really know their tax until mom and dad's returns were done. Well, we've gone back to those days. The Secure Act repealed the Tax Cuts and Jobs Act changes, so they're no longer going to be applicable with the tax rates. It's going to be taxed on the parent's highest rate. And it made that change back to the 2018 rules on a retroactive basis so that parents could elect to amend returns to go back if it was more preferential that it be taxed at the parent's marginal rate as opposed to the trust rates. So lots of moving parts on kids. CARES Act. So the CARES Act came in just to set it up a little bit, right? This started at the end of March. And if we think about the end of March, we were just starting to understand what COVID-19 was. Businesses were just starting to shut down. The stock market was just beginning its slide. And this was intended to do a couple of things. So we talked a little bit ago about IRAs and retirement plans and the required minimum distributions. Well, required minimum distributions are based on the owner's age and the fair market value of the account at the end of the prior year. So all of a sudden, we ended up with people who were forced to take a distribution on an account that was valued at December 31st of 19, very high. They've taken huge potential declines in values of that IRA, but that doesn't impact the required minimum distribution they're supposed to take. So one of the things the CARES Act did is it came in and said, you don't have to. We're going to suspend your required minimum distribution for 2020. So let's say I was in a position where my IRA came down substantially. I may still want to draw some from my IRA because I know rates are going to be lower this year, but maybe I only need to draw $50,000 to live, and I don't need to draw whatever that required number was, which was much higher, right? So again, it's may make sense to still take it because we know what our tax brackets are. You may have low income this year, but if your IRA took a substantial hit, you can suspend that, allow that money to grow. I mean, looking at the markets today, we know it's bounced back, so that's good. But the CARES Act made some real big changes around those. It also allowed for substantially more flexible loans and early distributions from both retirement plans and IRAs, but only for those impacted by COVID. So it waives the 10% penalty for early withdrawal. So if you're under age 59 and a half and you needed to take a distribution from your retirement plan or your IRA in order to meet your bills, there is the ability to get out of that penalty. However, you have to be somebody who is impacted by COVID. And somebody who is impacted by COVID is someone who is actually diagnosed with COVID themselves, has a spouse or a dependent who's been diagnosed with COVID, or somebody who has been subject to a quarantine, laid off from work, a work reduction. So it's got to, you have to have an immediate impact. I mean, I think all of us can say, I've been impacted by COVID, but they're waiving the penalty for people who have the likelihood of a substantial income impact as a result of a direct COVID diagnosis or quarantine or layoff. It also gives you the opportunity to put that money back into the plan over a 3-year period following the data distribution. So real quick example, let's say I was impacted by COVID, I needed some money, I took $12,000 out of my plan. I pay tax on that, I don't pay a penalty, and I pay that tax on 1/3 of that income each year for 3 years. So $4,000 for 2020, $4,000 for 2021, and $4,000 for 2022. Well, if I'm able to repay that $12,000 by the end of 2022, then I not only don't have to pay tax on that last $4,000, I can go back and amend my prior year returns to get those dollars back. Now, I know that's a small number, but if you think about it, you could take up to $100,000. So if I did take $100,000, I am paying tax on $33,000 a year for 3 years. If I can put that money back, I can go back and get those taxes back. Right. So that was a huge impact to people that were impacted in terms of being able to get some cash flow. Some other changes that the CARES Act made are around charitable contributions. So when we think about charitable contributions, they've always been subject to a limitation based on your adjusted gross income. Prior to the Tax Cuts and Jobs Act, it was 50% of your adjusted gross income. Post 2017, due to the Tax Cuts and Jobs Act, that went to 60% of your adjusted gross income. And under the CARES Act, it's 100% of your adjusted gross income on qualified contributions made during 2020. Now, I'm going to take a second. There are actually limitations that may be 20%, 30%, various percentages of your adjusted gross income that apply if, for example, you're doing capital gain property, or if you're giving it to special organizations. So I'm talking about the general contributions that are going to 501c3 churches, nonprofit hospitals, those kinds of things are subject to these different limitations. The qualified contributions that work for 2020 are current year cash contributions to churches, nonprofit, education, or medical institutions, or public charities in general, okay? And the other thing they did is they suspended the normal ordering rules. So under the normal ordering rules, you kind of go backwards. So you get your charitable contributions to your 50% charities first, and then if you've got some AGI left over, you go to your 20 and your 30%. This flipped it and said, if you've got some charitable contributions that are subject to those lower AGI limits, you can make those contributions first and then fill up your AGI with cash charitable contributions. So it's a pretty aggressive way to get money to charity if you have the ability to make those kinds of contributions. But for people who maybe their income has come way down as a result of COVID, yet their charitable giving limitations have maintained, they're going to be a beneficiary of that, in that they may still be able to take that full charitable even though their adjusted income is down substantially. Any questions there, Tim, before I go on?
Well, I would just say, Margaret, maybe you could address, there may be some businesses who've had tough times in 2020. And the reason I say businesses is a lot of our clients are partnerships or S Corps. So if someone is still charitably giving and let's say has a loss in their business, they don't lose those, right? I mean, they're still going to get a benefit of those charities and may move to a carry forward where that income limitation may come in for them, but they're not going to lose those charitable deductions if they end up through cost segregation, depreciation, or something else that might defer in or bring their taxable income down.
That's correct, Tim. There's a 5-year carryover. So if you can't take your charitable contribution deduction in the current year, you are able to carry that forward for 5 years and use it against future income. But this 100% of AGI is a 1-year thing. So maybe we've got a business owner where normally their income is $200,000 and they normally give, $20,000 or $30,000 to charity. They never get close to the limitation, but this year they had a loss in their business and their adjusted gross income is only $30,000. They may still be able to take 100% of their charitable, even though their income's way down. Now, if it's so far down that it's a loss and 100% is zero, that charitable that they make this year, they get a 5-year carryover on it. So let's talk estate and gift planning for a little bit. And I think estate and gift planning is something that could do its own presentation. It's a complex area, but let's talk high level and see if we can kind of get our arms around what some of the changes are. So currently, there's a lifetime exemption of $11,580,000. That started, and I'm going to give you a little history here. So that started with Obama. It was $3.5 million. It went up to $5 million at the end of 2012. And then it was changed in 2017 to $10 million retroactive, and it adjusts for inflation. So that $11,580,000 is really a $10 million indexed number. When they changed it from the $5 million indexed to the $10 million indexed, they did it with a sunset in 2025. So beginning in 2026, we go from the 10 million, which is currently 11,580, back to 5 million, but they will then index that forward to wherever we're at in 2025. So guessing somewhere in the high 5 million, $6 million range is where that's going to end up.
Hey, Margaret.
Yeah.
And we're doing good on time. So in addition to that history, maybe one of the things you could mention is going back to the historical process of tax and estate planning, where you didn't have this portability between husband and wife. Maybe you could just briefly mention what that means to our clients and the listeners out there, how that 11,580,000 is different maybe 15 years ago versus now in the current situation.
Sure, I can do that. So just to wrap that one thought up, though. So the Biden is going to take us down to 3.5 million. So the other thing to keep in mind is what Tim was mentioning is this is a per person exemption. So if you're a married couple filing jointly or a married couple, your exemption is really 11,580,000 for spouse one and 11,580,000 for spouse two, or combined about $23 million. In the event a spouse passes away, any exemption that they have not used carries over to the surviving spouse. So for example, I've got a client who passed away a couple of years ago when the exemption was a little over $11 million. He left his entire estate to his spouse. So even though he had no tax and he used none of his exemption, if she were to pass away today, she could pass $23 million tax-free to her heirs due to this carryover of his unused exemption. Well, one of the things that with this decline in the exemption amount, that carryover stays where it is. So if she does absolutely nothing and her exemption goes from 11,580,000 down to say 3.5 million, she's going to maintain that carryover exemption from her husband who passed away a couple of years ago. So for people who have lost a spouse in the past, you may not be as significantly impacted as a married couple where both people are living at the time that the law change occurs, assuming it occurs. But portability gives a lot of flexibility with regard to handling passing assets to the next generation.
And to clarify, the reason that in your example that he's not using any of his lifetime gift exclusion is because the transfer to his wife doesn't count towards that. That's unlimited. Right. So for those of you who are thinking, well, wait a minute, didn't he transfer his estate to his wife? That's unlimited. That does not apply against the lifetime gift exclusion. That's
correct, Tim. So there's also a change in the top marginal rate. So right now, the top marginal rate for estates is at 40%. The 2026, when it goes back, it's going to be 40%. So when they change the rate or the exemption from 5 million to 10, they didn't change the rate. Biden is proposing that rate goes up to 45%. So there is an increase there. And probably the biggest implication under the Biden proposals is no step up in basis at death. So just as an example, let's say you were really savvy and you bought Apple when it first started 30 years ago or longer, and you have $1 million of stock in Apple and you only paid $10,000 for it. So there's this huge gain. Well, under the current rules, if I own that stock when I die, yes, it's included in my estate at the fair market value, but my beneficiaries who get that stock, their basis is the fair market value on my date of death, or 6 months later if you use anyhow. It could be more, but anyhow, it gets that step up. And so when one of my beneficiaries sells an asset immediately after I die, they're not going to have an income tax on it. One of the proposals that Biden has is that step up at death goes away. So now I'm in a position where I paid $10,000, it's worth $1 million, it's included in my estate at $1 million, which either uses $1 million of exemption or I maybe pay tax on that $1 million. And then when my beneficiary gets it, if they sell it the next day, they still have $990,000 worth of gain that they're going to pay taxes on. And given the Biden proposal on increasing long-term capital gains from 20% to possibly as high as 39.6% for people with income over $1 million, that could be subject to an additional 20 to 40% tax. So a combined rate with the estate tax and the income tax layered on top of it is approaching 60 or 70% tax rates. The other challenge that the lack of step up has is the sheer administrative burden of trying to figure out what is that carryover basis. Because, put yourself in the shoes of somebody who inherits an asset from grandma who bought it 70 years ago, and your basis is whatever grandma paid for it. You may have no way of figuring that out. So administratively, there's a huge issue there around step up in basis that some people think that will never pass simply because of the administrative issues around trying to enforce and police that kind of a policy. So planning for changes in the estate and gift tax laws. So there are a lot of people that are currently looking at doing gifting now or planning now to protect against a change after Biden becomes president in January and after something happens. Now, it's very possible that any change that's made will be a prospective change. So you have some time in early 2021 to do these kinds of planning strategies. There's nothing that says they cannot do it retroactive till January 31st to January 1st of 2021. But typically they are prospective changes, so you probably have some time to deal with this. But when you think about ways to use your lifetime exemption, that's currently $11.5 million, prior to it going down, there are some strategies people are using. For example, forgiving a family loan. If I loaned money to my kids and I forgive that, that's considered a gift, and I can shelter it under my lifetime exemption. There's a type of trust out there called a defective grantor trust. I could sell something to the defective grantor trust and then forgive the loan. If I've got an irrevocable life insurance trust that I'm making annual gifts to fund that life insurance, I could make a large gift today, cover it with my lifetime exemption, and pre-fund those future life insurance premiums. One of the things you have to be careful about when you're using this gifting technique to utilize your lifetime exemption is, while you do get a step up when you leave assets at death, you do not get a step up when you gift something. And so if you gift low income or low basis property to utilize your lifetime exemption, you may be using your exemption, but you may be transferring an income tax issue. So you want to be careful that you think about how you do that transfer and what assets you gift. There's also a fairly popular type of trust that's called a spousal lifetime access trust. And this essentially means that one spouse sets up a trust for their other spouse and their children. So let me give you an example. Tim decides he's going to fund a spousal lifetime access trust. He sets up a trust. He takes assets that are currently in his name. He puts them into this trust. It's an irrevocable trust. His immediate beneficiary is his spouse. And if she passes, the assets go on to his children. So it gets out of his estate. He uses his lifetime exemption. His wife still has access to those assets, so they aren't completely out of his control. And then upon her death, it goes on to his children. So some of the risks there are, well, what happens if I do this $11.5 million gift to the trust, and God forbid, my wife passes away 2 or 3 years later? All those assets now go to your kids, and you don't have access to them anymore. So you don't want to do that with 100% of your assets. You could also run into a challenge if, for example, your wife were to divorce you, because now you've put all of your assets into a irrevocable trust that your wife has access to that will go on to your kids in the future, but you no longer have access because of the divorce. So there are some limitations to it, but if you're looking for a way to fully utilize an exemption, still have some access to those assets, the SLAT, S-L-A-T, SLAT for short, is a pretty popular planning technique that people are looking at right now. The other thing to consider is, whose exemption do I use? So right now, and historically, you've been able to elect to split gifts. So if I give $50,000, I can file an election that says myself and my spouse are going to elect to split that gift. And for gift tax purposes, it's deemed that I gave 25 and my spouse gave 25. Okay? In this situation where I'm trying to utilize my lifetime exemption, you may be better off not electing gift splitting. Because if you think about it, if I gift $11,580,000 and my spouse gifts nothing, we go into next year and the rules change, and even if it comes down to $3.5 million, I've covered $11.5 million in assets. My wife still has $3.5 million left of exemption for future gifting and transfers. Whereas if we had elected to gift split, I would have done half of mine. My spouse would have done half of it. We would have both given in excess of $5 million. And if the exemption comes down to 3.5, we have no more gifting available. So thinking carefully about, do I have one person gift all of it, or do I split, is something that's a more important issue than it's ever been before. And then again, step up in basis planning. What assets am I giving? If I've got high basis assets, those are better assets to gift than low basis assets, because again, a gift does not get that step up in basis. Oh, and that's my last slide. I thought there was another one.
So Margaret, no, we've covered all the questions. There's just a couple things I wanted to maybe address, and that this came up in last Thursday's event with Sarah. We would love to give comfort on how legislation typically tends to be prospective, but we have all seen in our careers where some legislation has been retroactive, and they've used some guidance, for example, of have they disclosed it. If you wanted to go ahead and unshare, people could see our pretty faces even bigger than those.
You warned me about that earlier. There you go.
There we go. And so I want to warn everybody that there could be what people would, or what the legislature and what the Internal Revenue Service and the Treasury Department would indicate was, hey, we gave you enough notice in telling you what our intent was, that when we finally put the pen to paper and created the legislation, we're going to say it's back to here. And I get nervous about estate planning issues, because you brought up so many, especially at the very end, some very good points. When you have appreciated property, declining property, you've got the gift splitting issue if there's a change to the overall lifetime exclusion. All of those things and the potential changes President-elect Biden may get through the legislature, those are a recipe for disaster if you're not thinking about those things well in advance. And it reminded me when you brought up the comment about if he were to not allow step up in basis, so you have this asset at its fair market value in your estate, boom, then your family goes and sells it, and they have carryover basis and they get taxed again, boom, you go into that same planning mode of sell losses before you die. And now in this case, you might be considering sell gains before you die, so they're only taxed one time, because cash would be cash. So I want to make sure everybody understands that I started off in my opening remarks talking about change, and our change has nothing to do with technology. It has to do with the law, the legislature, court cases. I think it's important people really realize the level of encouraging them to seek advice, because of those 4 or 5 things right there at the end, how it could impact substantially their ability to pass on to their heirs more than less because of poor tax planning.
Absolutely.
So,
absolutely. So,
Casey, you've been just full of insight, typing like a madman. Any chance you wanted to share any comments? Was there anything where we were going through this that you wanted to redress or emphasize?
Looks like you gave me about 60 seconds, so I get to get all my thoughts out there now.
Thank you, Casey. Thank you for wasting your 30 seconds. Thanks for wasting your 30 seconds on telling me how little time I gave you. Yeah.
No, I think that Margaret did a really good job covering a lot of the things. If anything, reiterating the fact that everything that we've talked about being proposed, it's not as if there's a clock out there that everybody has to rush to get something done by 12/31. Yeah. I think that in general, if estate planning was in the works and you were already planning on doing some things, don't stop that process. Obviously, keep your advisors in the loop on what you're thinking and what you want to do and what you may want to, change to, considering what we now know and the election results. But in general, we don't want people to think that, hey, it's all of a sudden time that you have to do all this stuff really quickly. Definitely speak with your advisors and see what makes the most sense. But a lot of people are in the boat that, hey, I want to wait and see what happens. Some people are saying, I want to take a chance. Let's do it now. There's no right answer.
Yeah, and I think the one thing we didn't even talk about, which is this hindsight being 2020, with what we think may happen, which is a stated increase in taxes, right? I mean, it's a fact. Now that doesn't mean legislation would pass. And I was going to go back at the beginning and ask you, do you recall the last time we had the president? So we had the executive branch and both congressional branches, the same political party. I could not recall, because I feel like, especially from Bush forward, we were dealing with the sunset provisions of more of a negotiation to get legislation through. And thankfully under President Obama, a lot of that stuff became permanent. But I can't remember the last time we had, where one party could kind of do what they wanted.
I'm going to say you were supposed to Google that while I was typing.
Yeah, I should have Googled it.
Oh,
but
somebody
might have been
somebody said
2016.
2016.
All right. Well, that's sooner than I thought. That doesn't make sense. Because we had wasn't President?
I don't agree with that. That's a Google question for another day.
I thought the House has been Democratic, but maybe Paul is right. Paul is popping in there. Trump's first 2 years, we were all Republican, I guess. But anyhow, so we're at 4:00. I just want to tell everybody, thanks so much. Thanks, Margaret. Thanks, Casey. A lot of effort goes into this. The figuring out the bandwidth of these events is huge, and just deciding what are some of the key things. We've scratched the surface. Hopefully this gets you all thinking about tax planning. There's certainly considerations about should you accelerate or defer income, depending on that hindsight being 2020, or where your crystal ball says 2021 might go. But we want to thank everybody for participating. As I said before, please look for a follow-up related to the live video, as well as the questions. But hopefully this has been helpful, as well as Margaret's presentation will be available. It'll be embedded in the presentation. So we thank you all for your feedback. If you have anything that you think is we overlooked, or something that you'd like a specific reach out, feel free to reach out to Denise Asker, our marketing director, or somebody within our administrative organization. They'll make sure the questions get to us. I want to remind everybody that the PPP program on December 15th is really geared towards the lender perspective, and how they might see their clients presenting those loans and how it might impact cash flow and loan covenants. So if that's of interest for you, definitely seek out RMA's website and try to register. I didn't want to mislead those of you who are in the middle of calculating your loan forgiveness applications, that we were going to be diving into that. There's still a lot of ambiguities and a lot of potential there. And hopefully with any luck, by Tuesday of next week, maybe we'll have a better idea of what this next stimulus bill might be. The biggest thing it would impact probably everybody on this call, whether you're a closely held business, a shareholder or a partner of a closely held business, or you're self-employed, it could be the impact of the taxation of this PPP loan forgiveness. So with any luck, we will have some good news next week. I'm convinced that any stimulus package is good for us. This is helping our government, unlike anything. Margaret and I've talked about this before. We may never see this again in our lifetime, where they put money out there and didn't just do the typical tax rate cut or the interest rate cut. This really was impactful to our clients. So again, thank you all. Look forward to talking soon. Margaret and Casey, thank you so much.
Great. Thanks, Tim. Thanks, everybody. Have a great